Hi, welcome. Sorry for the delay there. This is our first live event. Hi, welcome to Shapcott's Accountants. Today we're going to be talking about property and what's been happening in the budget, which was last week. So, what has changed? What's happening? Where are we going with things? So let me start with one of the general questions that I get asked so very often, and that is, should I be buying in a limited company or should I be buying in my own name? Now, this is quite a key question, and the reason it's a key question is because it has such a big impact on how we're taxed, depending whether it's in your own name or whether it's in a company. Now, earlier in the year, ahead of the budget, they announced that they were going to be increasing the dividend rate from 7.5% to 8.75%. So there was a few question marks of whether is it still worthwhile doing things in a company. Now, we obviously know the personal tax rates are staying the same. We know the personal allowance. We know quite a lot of things that are going to be staying the same for the next couple of years, at least for what we are aware of from the most recent budget, which kind of means yes is the answer. It is still worthwhile buying in a limited company when you are ticking those crucial boxes. Now, when I say ticking the crucial boxes, I'm talking things like you may be a higher rate taxpayer and you're still going to be working. So from that point of view, it's really quite crucial that hopefully you're not going to be paying loads of extra higher rate taxes. It may be you're doing things that are slightly risky. So if you're doing things that are slightly risky, then it's probably beneficial to put it in a company and put it in that wrapper. So hopefully if anything did go wrong, you're not going to be losing your shirt or your house or whatever else you might have to lose from that point of view. So that's another reason why it might still be worthwhile. So overall, even though there are some changes coming in corporate structures, which just to very briefly mention, we are at 19% corporation tax at the moment. Now, that is set to change in a couple of years, and that is from the 1st of April 2023. And from that point, we're going to be seeing an introduction of a higher rate of 25% on profits over 250,000. Now, this high rate of 250,000 is where you'll start paying that 25%. Up to 50,000 profits, you'll be paying 19%. And then in between the 50 and the 250,000, you'll be paying a marginal rate of tax, which tends to be slightly higher. So anyone who's going over 50 but not hitting 250, you might find the tax rate slightly increased. Now, even with those increases, there is still a relevance for having a limited company. And the reason I say relevance, because if you are a high rate taxpayer or having additional property income is going to be making you into a high rate taxpayer, then there is still a benefit there to having a company. Now, the other thing to mention about having a company is you can also do some inheritance tax planning. And one thing we found in this budget was no mention really of inheritance tax. Now, that's possibly good news, bad news. Good news, our planning that we're looking at the moment is still relevant and is still what we can be planning. Bad news is at some point they may make some changes. It's just we don't quite know what it's going to be yet. So that is kind of a watch this space. Keep an eye on what's happening as we see new budgets coming through. But at the moment, what we have in place is working, which means you can be spreading the shareholdings amongst children, amongst different family members who you want to get involved in the company. So you can spread that inheritance tax impact at an early stage and also get some of the benefits of having children and grandchildren within your corporate structure. Now, we're kind of entering this time period now where, because taxes are starting to go up and rates are changing and things are shifting, we are now actually approaching a time where we're actually saying it's better to pay your tax sooner rather than later, which has been an interesting time period because I suppose for the last quite a while, probably decade or so, we've actually been saying push your taxes back. So if you don't need to pay the tax, pay it later. not evading or avoiding, but just if you're not doing something, don't take the money out of your company. You don't need to worry about spending your money now to get your capital allowances. There's been a few things where, because the tax rates have been relatively low and because the tax rates haven't changed, actually, we've not really needed to worry about different tax rates. At this point in time, we're approaching increasing tax rates. So therefore, if you do have some tax to pay and you know you're going to have to pay tax on something, it's kind of better to pay it sooner rather than later. Really on the method that the tax rates now are lower than they're going to be. So if you pay your tax now and get it all cleared and tax paid, then any, say, distributable reserves from your company are there available for you, and you're not going to have to pay tax at a higher rate in the future when you're looking at the tax position. That includes taking dividends out, which is probably a good place for us to move on to. So the next area is really taking out money out of our company. That's going up from next April. So on the 6th of April 2022, it's going up to 8.75% tax. So a real key thing here is if you do have distributable reserve and you're maybe not using that full 50,000 and there are reserves there, it might be an idea to vote a dividend and take that money out of the company. And that really is quite a kind of a crucial thing in there to, I suppose, save you 1.25% tax. Now, as you can appreciate, it's not much. There is money there, but it's only a couple of £100. So it's not big numbers. But if you were thinking of taking the money out for a house deposit or a holiday, or I don't know, kids going off to uni, you need some funds to pay tuition fees, it may be worth taking that money out a little earlier than you were planning on doing, just to save that couple of £100 tax that you didn't need to pay. One crucial thing that I have been hearing is potentially you will need to actually physically take that cash out of the company to show that you have taken it and you're not just voting dividends. So if the cash is there, then hopefully you can take it out, even if you do at a later stage pay it back into the company if the company needs that cash for other investments that you are making. Now, the basic rate tax band, which has historically in the last couple of years been around the 50,000 mark, that's going up to 50,270. So a slight increase, but not very much. So that's just something to be aware of if you're planning how much income you're going to be having over the next tax year. There's maybe a couple of hundred extra that you may be able to take. Now, that probably covers most of the things on the company side of things and taking money out your company with the updates of what has happened. The next thing I want to kind of briefly cover, which could be an opportunity for property investors and definitely something that is worth considering, is business rates. Now, if you are investing in commercial property, business rates has just been retained. They've not made any significant changes at this exact moment in time. And what they've actually done is they're looking at reforming it. Now, the reason there's the opportunity here now, especially in this area with the rate side of things, is that they're giving discounts out to retail, hospitality and leisure. They're trying to support the high street. Now, this kind of means that if you are buying these sorts of property and renting things out, then hopefully you're going to find that there is more tenants there because the rates is not such a big impact for you, and it's not going to cause a problem for your tenant because they're going to pretty much hopefully be able to get rates relief. So it kind of cuts the bill. Now, there is also the point where they are keeping some of the small business rates relief schemes open. So that will maybe even cut certain things down to zero, which is obviously a real positive for smaller businesses. And they're freezing things for the next couple of years. So any rates changes is going to be similar to what it was in the previous year. There's not going to be any great uplifts in it. They have also done a few different green measures to help businesses upgrade existing properties. And in that sense, hopefully that is meaning there are capital allowances available to claim either in the business or for yourself if you are looking at putting things into those properties. Key things really are going to be the renewables, the electric points for vehicles. A key one coming forward is going to be the low carbon heat pumps and things like that, which are coming forward, where there's quite a lot of support available. And if you're putting these sorts of things into those properties, it would be something to be assessing what capital allowances may be available. One key thing to mention today for capital gains tax, which I don't know if it's positive or a negative, is capital gains tax, that this has stayed the same. Now, this is one of those areas where, again, good news, bad news, they've not touched it yet. Now, the reason I say yet is because there's still speculation that something will happen with this at some point. But from this budget, we've got no significant changes. The rates are the same. The annual allowances are the same. So they've not made it any worse, they've not made it any better. The key thing that they did mention, which is quite useful, is that rather than 30 days to file your return and make your payment, they've now doubled that. So if you sell a property as of the 27th of October this year, 2021, you will be able to have 60 days to complete your capital gains tax return and make your capital gains tax payment. So that is good news. It just gives a bit more time to get all the data together. I am aware solicitors are not necessarily always telling you need to do this. So it is something to be aware of and speak to your accountant. I know we're doing quite a few catch-up ones, unfortunately, because clients haven't mentioned that they've sold a property. So tell your accountants as it's happening, when you're completing, and then you can work with them to get these returns submitted into HM Revenue and Customs and pay the tax on time, so there's no risk that there's any penalties or any interest that might be payable. We've already mentioned that there's been no changes to inheritance tax, so any planning that has been put into place that you may have been considering has already been dealt with, and from this point of view, you're good at the moment. It is an area we are keeping an eye on because we are expecting something at some point, whether that's increasing in the limits, whether that is completely revamping it, we just don't know. But for now, we are safe with inheritance tax and they're not doing anything too radical just yet. The next one I wanted to mention is our stamp duty update. No changes at this point in time. They've not really made any impact on this tax, so that's a positive. They changed to add the additional 3% a number of years ago. That is still the case. There's been no significant changes since then. So the main thing that I will say is on our next update in the next couple of months, we will cover some of the exemptions available to just make sure you're aware of how you can actually maybe find some good opportunities and good project by taking advantage of some of these exemptions that are available with stamp duty payments. Now, another area that has been a big impact to a large developers is the property developers levy that they've introduced. Now, for many of our clients, many property investors I know, it's probably not going to impact you directly because your profits have to be over 25 million. And if that's the case, then you'll be paying a 4% levy on your profits, which is basically going into a fund which is probably going to be helping the cladding issue that obviously came about from the Grenfell fire and the cladding issues there, and has opened up a whole can of worms with all the cladding issues other high-rise blocks have had. So this tax is really going to start to help address some of those issues. But the impact it may have is if they're having to pay extra taxes, then this might have an impact on what properties are being put on the market for, level of finish, these sorts of things, because obviously that is going to be a direct hit on their profits. So this is something to just have in the back of your mind. And if you are a developer who's getting to that sort of level, then just be aware that this is coming. Hopefully nothing too big for most property investors that I'm hopefully talking to today. Now, a final area that I wanted to cover today, just on our really brief update for you, was making tax digital. Now, you may or may not have seen recent press releases out there, but making tax digital is happening and it is going to affect landlords. Now, all property investors who have property that they're receiving income from may be affected. The positive from what we got not long ago, and he reinforced in the budget, was that things have been delayed by a year. So rather than things kicking off in 23-24, we've now got until the 6th of April 2024 for the first time that the making tax digital side of things comes into play. So that's great news, really. We've got time on our hands. Now, as a property investor, you are going to be impacted by this if your income is over 10,000. So if your income from property is over 10,000, you will be in the regime and you will have to follow the requirements. That being said, if you have income from other sources, so I'm talking about self-employed here, so you may be a self-employed builder who has some property investment as well. If your self-employment and your property income are added together is over 10,000, you will also be in the regime as well. So just because your property income isn't over 10,000 doesn't mean you're definitely not going to be affected. It may just be you're included because of a slightly different reason. Now, this 10,000 is based on rental income. So it's not based on profits or what you are, it is based on the rental income that you are receiving. Now, what you will need to do is go about setting some sort of software together. So you'll need to keep your reg records digitally. So if you're just literally keeping track in your bank account, then that possibly may not be enough anymore. What you'll need to be doing is either keeping some sort of spreadsheet or using some sort of software to enable a submission to be made to HM Revenue Customs. And what submissions do you need to do? So the submissions you need to do are going to be quarterly submissions based on the tax year. So as a rental business, as a rental income summary, you are going to need to do it on a quarterly basis. So April, May, June, you'll have to do the period to the 5th of June each tax year, and you will have to submit it by the 5th of July. So then you'll have your June, July, August period, and then you'll have to submit it 30 days later, and so on throughout the year. So you'll have 4 submissions to make over a tax year. Now, there will be still arguably what's known a tax return, but this will be a final submission going forward. So that will cover everything you've already submitted and all the normal data that you would have to submit. So it is a little extra burden, but hopefully it's not going to be too much of a hiccup. If you're using something like Excel, you will need to use some sort of bridging software, but we'll be able to support our clients with that. And obviously, we need to just keep in touch with your accountant to see how you can make sure it all fits together. Now, this is going to affect anyone who has rental income in their own name. Now, if you have properties but they're in a corporate structure, you might ask, well, is this covered? Yes, but not yet, is kind of the answer. The properties that are in your company are in the corporate tax regime. And at this point in time, the corporate tax regime is not included in this method. So the corporation tax regime is going to be mandated 2026 or after. So depending how well and how smoothly the self-assessment and the rental income introduction goes, that will probably determine whether it comes pretty swiftly in 2026 or whether that gets pushed back a year or two. It is coming. It will probably be similar sorts of things where we'll have to do quarterly submissions of data and then a final corporation tax return. But we don't know any of the details of that just yet. It's just very vague information on that side of things, but that will be following. Now, that hopefully gives you an idea of what has happened in the budget. So the key kind of takeaways, hopefully, that you can get today is that it's still worthwhile buying in a limited company if the circumstances are right for you. And if you're not sure, let us know and we can talk those through and hopefully help you get to the right assessment. Dividends taking out a company, they've gone up slightly, as have the PAYE, national insurance rates, but generally we're finding for property investors, they're not so important. It's more the dividend rate that is really key to you. Most of the rates have been frozen, so things like your personal allowance, the tax brackets, the tax rates, at the minute we're not expecting any shifts or changes. Those have all been frozen. There may be some opportunities with the property, commercial property, because that is all looking at the business rate side of things, which is a very big expense for any commercial tenant or commercial landlord. So there may be some opportunities to look at there. Capital gains tax, on a positive, there was very little impact, and it just gave us a little more time for reporting. And inheritance tax, again, no significant changes. Final bits really is that making tax digital. Be aware of it and make sure that you are starting to look at how to deal with it. We have time, we have knowledge on what is coming, we know how we can deal with this, so please do speak to us, please do talk to the right person to help get things set up so that it's not a big surprise or a big problem for you. It's just one of those things, and it's an opportunity to hopefully get more data on your portfolio of properties. If you have any questions, please do send them through, and I will stay on the stream for a minute just to clear any questions that you may have. But hopefully today you found some information on what has happened with the budget to keep you updated for your property portfolio and your property business. Thanks for joining us today.